Now we can flip to, what is happening with PMI, the product managers index. What are we seeing? And let's start with global first, and then we'll start to drill down. And again, please, I'd like to remind you, like, share, subscribe. Sharing is a huge help. We've crossed 1,500 subscribers, and we'd like to keep that going and expanding as much as possible. So when we look at the improvement, you can see that we're still in expansionary territory, which is a net positive given where we came from. Anything above 50, even though it's obviously much closer to 52, given 48 to 52 is kind of like just hanging around the normal. But when we look at the consumer, let's start there. The consumer is the one that we continue to be concerned about, because that's the one that is facing a limited job growth, pressure on the salary side in terms of what are they going to be able to spend given what their wages will be. And then when we look at investment, again, like we had a big surge, obviously things normalize, and now we're starting to see that roll over as loans tighten up a little bit in terms of borrowing, and the pressure starts to mount. And that's why we know there's some problems in that. When we look at the intermediate, we think it's going to start to roll over. It pulled things higher. Now we think that there's going to be pressure to the downside, especially as we have increasing in prices, which is going to increase inflation. Again, things that are just going to kind of cap where we are. Not saying that we're going to see this huge drop. That's not the case, because we've come out of this. The question will be how quickly and what is the pace, and that's where we remain concerned as the consumer struggles, not just in the U.S., but on a global level. Which is why when we turn and we look at, okay, well, let's look at manufacturing. Manufacturing starting to kind of roll over, because you can get a supply recovery which can last for an extended period of time. But if you don't have demand on the other side, it creates a problem. And the supply recovery is you have a surge in demand, drains down all of your inventory, and you have to fill that supply. So now, as you're filling that supply, you're starting to normalize the supply chain. You're starting to get inventories back up. That's when you start to see, okay, well, where's the demand level next? And that's why, like, when we look at 18 into 19, 19 into 20, this is where we were getting concerned. When we looked at what is happening in 2019 heading into 2020, you saw a little bit of a bounce, but we were seeing a lot of weakness on a lot of different levels. And then obviously, the floor gave out. And that's why now we have a quick snapback, and we think the trajectory is going to go in a very similar level. It's obviously going to be a little bit quicker, just given lockdowns, COVID, and the like, that is going to put pressure on the manufacturing side. But with that being said, it is surprising to the upside, which is a positive for manufacturing. But we're seeing employment numbers surprise to the downside and/or stay right around 50. So if you think about employment going to 30, people getting fired, layoffs, furloughs, we haven't normalized that. And now you get manufacturing going up. And even though manufacturing is going up and people feel better about it in terms of what's happening with new orders, global orders, employment's not reacting. And that, as we said at the very beginning of all of this, that jobs was going to go from a lagging indicator to a leading indicator. And we're seeing it here where we're just not getting people hired back, which means that there's going to be less jobs, which means that there's going to be more competition for the job. So you'll accept a lower salary, which means that you have less money to spend, if you have any money at all, because maybe you weren't able to get a new job and you're still waiting for that job. And that's, again, these problems that we continue to see back and forth. Now, when we look at manufacturing output index versus global manufacturing production. So this is why we talk about leading indicators. So the PMI is up. The actual global manufacturing production is still down, technically below where, well, I shouldn't say down. It's just above positive. It's just positive. But again, like, this is saying that, look, we're going to continue to get production going up, which is a positive, because again, that lagging, real indicator versus leading indicator. So we're going to see that pull higher. It's going to take time before we see that whittle down into new job, or trickle down to new jobs. And by the time it does, have we seen the rollover in PMI? And now you're operating with 20% less. you're operating with 30% less employees, and now you're more profitable, but at the same time, you're providing less jobs, which means that they need to go out somewhere else, find a replacement. And again, this is where we keep coming to the consumer and how quickly can we actually see that turnaround. Then when we look at, okay, well, there's less companies out there to get a job with. And people have been having fun with headlines in terms of like, this is the least amount ever. But when we look at annual U.S. bankruptcy filings, they jumped to the highest since 2009. This is looking at public and private companies with liabilities above $50 million. So that's why when you look at headlines that say that this is the least amount of bankruptcies ever, how many of them factor into companies with above 50 million liability? So did the PPP loans and other types of small business loans help offset the bankruptcies of these small companies while the bigger ones continue to set records that we haven't seen since 08-09 in terms of the pace of bankruptcies, which we think will remain accelerated through, essentially March, as March is another big year, a big month for bond maturities. And where is it happening? Well, there's consumer discretionary, energy, which anyone who's in energy and watches the EIA shows and watching this, you understand the pain. Then there's retail and healthcare. So you can see that it's still the consumer and energy, even if we go back to 08-09 and then the start of the energy, the collapse in pricing, 15, 16, we're outpacing that. And again, this is on the higher level. This is 50 million in liabilities, public, private. Again, this is the biggest problem because these people are the ones that are, we're going to have some of them more employees. They're going to be bigger companies. And are they going to be able to sell themselves or liquidate? Or are they going to be able to, liquidate or come out of bankruptcy? But if you come out of bankruptcy, it's going to be at a reduced rate because you're going to try to shrink to go bootstrap to grow back up, which, again, this is just limiting the amount of jobs out there for people to get, for salaries to grow, which we're seeing in hours worked. So when we look at employees at home-based client firms, the percent change from January 2020, you can see that obviously the holidays happened and now we're just not getting that bounce. And it's bouncing, but it's not going to get to the level that we started from as we started to see it roll over, as companies said, look, I can't, 2020 was bad. I can't do any better in 2021. We're going to have to close up. And that's why the downtrend, I mean, obviously we'll continue to bounce off the lows, but the downtrend is still going to be in place. And we're going to settle out at something closer to negative 35% as we head into the next 6 months, which again, jobs, money, how are people going to do things? And then here's the data now. Now, when we look at December ADP payrolls, we see that we had the first negative print since March, where payrolls were down 123,000 versus 75, an estimate of a positive 75,000. We had the prior revised down. Large businesses were reduced 147,000. Mid-sized increased 37,000, and small decreased 13,000. So large businesses and small businesses continue to shrink and get worse. And now, will this show up in non-farm and private payrolls? The ADP and those used to have a much closer correlation, but that's broken down a bit. And it's just the trend is what matters, I think, most, where the trend is down 754, 409, 304, and we're seeing a similar trend in the government data as well, which again, putting just more pressure on the consumer overall. And this is something that Oxford Economics and Harvard Analytics put together, what their expectations are of non-farm payroll of a negative 24,000. As we've been talking about, the recovery bounce, we had a strong bounce, then the slope started to kind of gradually, flatten out, and now it's curving back down. And this is what we've been concerned about this curve back over, where we're seeing additional pressure, which is going to continue into January and not just reverse higher. Given these are estimates, we still need to wait to see what the full numbers are, but it's just we're heading into an area that's going to be an overarching problem. And when we look at job postings, so obviously December is less gets done in December and January, and then hiring starts to pick back up in February and March. But you can see that we're still not getting back to where we were in 19, and 19 started to weaken in November. Obviously 18 was a stronger year, but this is going to be a problem because I think there's going to be an acceleration to the downside where we're just not going to see as many jobs coming back overall, just because people are learning to do more with less and trying to build back up revenue, margin, and they're finding they're capable to do it with just less employees, which was our expectation in 2019, as COVID again provided the excuse to lay people off. And that is the biggest problem, because it's not easy to fire someone. And when you have a free opportunity with COVID, you're not going to be so quick to hire people back, which again is going to be a problem. And then when we look at PMI, so December composite PMI, the flash reading was 55.7, came in at 55.3. Services came in at 54.8. It was expected to be 50. The flash was 55.3. The index has fallen now from 58.6 in November to 55.3 in December. Still positive, still moving, but again, that's the spike, and now we're kind of rolling over, and we're losing momentum into January. Now, can a stimulus check help adjust that? Can it kind of stem that slowdown? Sure, absolutely. We see it from here. We saw the quick spike, but where is that going to be? How sustainable is that? And that's when we look at this is the lowest reading since September, 6th consecutive month of expansion, positive. Employment side. Employment went from 56.8 in November down to 53.2. Still expansionary, but slowing, which again, that's the bigger problem. And then input prices rise versus prior month, and it's the highest reading since the series began in October 2009. Input prices is a problem because that is going to get passed through to the consumer, and it's going to increase prices overall, increasing inflation. I mean, I've said it before on the show. I'll say it again. $17 for paper towels became $32 for paper towels. That is a real number. We see home prices up 8%. I know personally my food, the grocery store, it's 17% more than previous. I mean, these are real impacts to real dollars, real people that is being ignored. And with employment slowing, it's going to become more pronounced, especially because that means wage growth goes down. Real wages are going to get hurt, just as input prices are surging. And what does surging mean? Well, let's look at the manufacturing PMI. So, December was at 60.7, obviously a huge number, a big push higher. But again, inventories are kind of flattish, nothing too crazy. Supplier deliveries is, I think, the biggest one that we have to talk about, because supplier deliveries is pushing that number higher as we're seeing more bottlenecks. As we talked about in the EIA show part 2, we're seeing a big problem in terms of bottlenecks, which is pushing more trucks on the road, increasing cost, because you're seeing those prices. Now, prices went from 65.4 in November, already high, to 77.6. This is a huge number, which is essentially pushing PMI higher artificially. So obviously it's still a good number, even if you normalize that. But again, these are problems because backlog of orders is good. New export orders is good. It's the prices that are going to be the problem, because when we look at it, the expectations are, and this is quoted from them, facing weaker demand due to the pandemic, but we're also seeing COVID-19 disruptions, supply chains, further shipping delays, and creating more problems. These delays are limiting production capabilities as well as driving producer input prices sharply higher. Firms nevertheless remain positive. It's just, again, at some point this is going to catch up, which is why when we look at headline new orders production, you see it's all moving in the right direction. We're now kind of bouncing around. And the view is that we're starting to see a little bit of that rollover, but it's being supported from supply, and we're going to start to see some of that pressure as some of that normalizes and some of that those bottlenecks go away or are addressed at a specific price. And then so this is looking at something similar, just kind of showing you business employment, putting it on perspective. So business employment, again, strong bounce, kind of back down. So we're just hanging around at this nothing level where we're not seeing a big addition, which is why, again, coming back to what is non-farm payroll going to be? What is private payroll going to be? We've seen with ADP. This is where that rubber meets the road, and that's going to be the bigger problem. And then, well, how much does it drive? Like when I say that, okay, well, what are supplier deliveries add to the ISM numbers? And here's where you can see it. So without ISM, so assume supplier deliveries was normal. And it means we're at 55, which is still a good number. It's just you're getting an idea of how inflated it can get because of bottlenecks. And what is that going to do in terms of production as you struggle to get inventory, as you struggle to maintain levels of throughput? That will start to weigh on kind of where things go, which is why when you look at this in a little differently, the supplier orders, you get that context in terms of those problems. But when we look at construction spending, so October was revised to 1.6 from 1.3. November forecast was, it had this range of 0.2 to 1.8%. And we came in at 0.9. So again, we're still seeing construction spending, but there's kind of this bifurcated move where private construction rose 1.2%, which private residential was up 2.7%. And then you had public construction down 0.2%, private non-residential construction down 0.8%. So again, it's the difference between private, commercial versus residential, which is why when we look at this a little differently, you can see how we have that bifurcation where non-residential has come under significant pressure and residential has just surged back to levels that we've seen that since 2016, 2014. And this will continue. Like this is something that would you can look from 2011, 2012, that we didn't really close those alligator jaws until we got to 2013. And there's really nothing to say right now that in 2021, this will be any different, because it won't be. This is going to remain through the remainder of the year. And now when we look at, okay, well, public construction, where is it? Public safety, healthcare, we obviously know that, based on what we've seen. Highway, street, conservation, and this piece is driving down that total. Healthcare, public safety, obviously with COVID, temporary buildings. This is something that is shifting us higher, but still the total is still in that contractionary standpoint, which is again that negative to GDP in terms of, obviously construction overall, investment overall is up when we factor in private. But again, this is the one that we're going to have to see more infrastructure spending, more, because what does it do? It brings jobs. If you're building new roads, if you're fixing new roads, you're hiring people to do it. Again, delivering more to the underlying. And that's why when we look at ISM manufacturing, industrial production, which is why we're still going to see a change. Like we're still going to have that nice snapback, especially because things are kind of the indicative of it. The question is going to be, what does the consumer do? Does the consumer buy? Is this just going to go into inventory? So does the consumer not buy? And then the employment becomes the bigger question as we go into the next segment, looking at the finances of the consumer and where we're seeing stress, where we're seeing leverage, and what does that mean through at least the beginning of 2021.